Okay, guys, great to be with you today. So this presentation today is the five biggest financial mistakes that I've encountered with trades and construction businesses over the last 20 years. So hopefully this is just a little bit of an insight into that for you today. So just about small business, the ABS, Australian Bureau of Statistics, defines small business as a business employing fewer than 20 people. So by definition, probably all of you guys would be small businesses. Would that be right? Yeah. And some food for thought here with some research that I've had undertaken is that 56% of small business owners with less than 6 employees do their own bookkeeping. Just hands up there if any of you guys do your own bookkeeping. Have you got fewer than 6 staff? Yes. The next statistic, so these statistics are somewhat linked. 60% of small business owners feel they don't know enough about accounting and finance. So Ryan and Mary, do you feel like you know enough about accounting and finance? So yeah, statistics are somewhat right there. And the next statistic is that 82% of small business failures are due to poor cash flow / financial management. So what I'm inferring with those statistics is that, a lot of small business owners are doing their own bookkeeping. They don't feel they're really good at doing their own bookkeeping. They don't feel like they know enough about accounting and finance. And I would sort of suggest that perhaps a reason for a lot of the failures is that might be one of the reasons for that. Um, so the first mistake I often see with uh, trades and construction businesses is just that, doing your own bookkeeping. And there's nothing wrong with doing your own bookkeeping, particularly if you're good at it, but it is a common trap for trades and construction. And the reason is that bookkeeping is the backbone of your business finances. So if you don't feel you know enough about accounting and finance and you're doing your own bookkeeping, it'd be me saying to myself, look, I don't know enough about construction, and I'm going to build my own house. It's a similar sort of analogy there. And getting it right, bookkeeping that is the easiest way to gain financial visibility about your business's finances. So I'll just run through this, the common mistakes that I see here. We've got a chart, a table there of 1, 2, 3. So one is financial transactions. So sales equals income in your chart of accounts, and that goes through to the income statement or profit and loss on your financial reports. Materials and subcontract labour, often categorised as cost of goods sold, and that again goes through to the profit and loss statement. And things like utilities, insurance, rents, and sometimes salaries are categorised as overhead expenses or expenses, and that also goes through the profit and loss. Whereas things like purchasing equipment, so you might buy a new truck or trailer or piece of equipment for your business, that's an asset which goes to the balance sheet. You might take out a loan, which is, maybe you bought that equipment under a chattel mortgage or something like that, and that is a liability that again goes through the balance sheet. And when you take money from the business, that is most often equity, which again goes through to which goes onto the balance sheet. So accounts can be thought of as categories, and not knowing the difference between profit and loss accounts and balance sheet accounts can often lead to misallocations. And we'll talk about that in the fifth biggest mistake a bit later on, why that's an issue. So the common mistakes I see with doing your own bookkeeping is not fully understanding how the software works, overcomplicating the chart of accounts. As an example there, I looked at a clients when they're coming on board profit and loss in MYOB, and they had 34, 35 motor vehicle expense accounts. They had 5 vehicles, and fuel, repairs, registration, insurance, and oil, I think it might have been. Each vehicle had an account for its own expense. So when you looked at the profit and loss, it was just this sort of 3-page profit and loss, which was just a mess. There's no need to overcomplicate the chart of accounts with that. Not reconciling bank and credit card statements. So, for example, if you don't know how to reconcile something, you'll just leave it there and not, not address it. Not reviewing the financial reports regularly. Bookkeeping inexperience. Improper categorizing of GST. Coding payments to yourself as an expense. And not keeping receipts and records. That's quite not many trades and construction business owners love keeping, detailed records, but that is an issue. And if any of you are sole traders, the other biggest mistake is not having a profit business bank account. So sometimes when you're a sole trader, you just run your business through your general revenue household account, and then that just makes the process of working out how your business going, so much more complicated because you have to unpack the private expenses and separate them from the business expenses. So the second biggest mistake, and this is the order that I would be recommending to knock these off in your business, is not having a budget in place. That's probably the key thing. The budget is basically a financial blueprint or a financial strategy on how your business can make a profit and pay you a wage. So that's why we want to have a business budget in place, because you're running business, it's not easy at the best of times. And not investing properly in the finance and accounting function of your business can lead to things like not having a budget in place. So you don't know what margins you need to have to pay for your overheads, or what gross profit margin you need to have to pay for your overheads. And those overheads should include a wage to yourself, like proper wage, whatever the market rate is for your job, and also for your business to make a 10% net profit. The tool, like we talk about tools, you guys all love your tools, right? So we're talking about on-site tools. You're going to pick the right tool for the job. You're not going to buy the wrong tool for the job. Now, off-site, back in the office, the tool you need to make a profit in your business, or to plan to make a profit in your business, is a business budget. Now, the risk of not having a budget is that you build a very successful business in terms of operations. You're doing a great job. Customers love you. There's no rework, high quality. You can pay your employees and suppliers, but you're not able to pay yourself what you deserve. Now, I'm not going to ask anyone to put up their hands, but in my experience, businesses without a budget, 8 out of 10 business owners in that situation would put their hand up and say that they don't feel like they're paying themselves what they deserve for what they're putting into their business. And that's actually why you need a budget. We need to set the finances in your business properly to get you to pay yourself. The second risk of not having a budget is sometimes, businesses without a budget are not able to pay their employees, suppliers, or loan repayments, or the ATO. And the cash flow can start to spiral out of control. Payment arrangements and even payment arrangements with suppliers, and it's just as soon as the money comes in, it's just as quickly going out. Now, the reason why this is number 2 is that if you've got poor quality bookkeeping, it's very, very difficult to do a budget, because having your bookkeeping organized makes the budgeting so much simpler, because things are organized and categorized properly. So if we think about that example before where I said an electrical business had 34 accounts for motor vehicle expenses, there's just a lot of work in working out a budget for each of those 34 different accounts. It doesn't need to be that complicated. So high quality bookkeeping makes budgeting easy. So some key points here. It's easy to ignore your accounting until things get bad or really bad. So you must have a business budget. And some common attitudes towards budgeting that I've heard over the last 20 years are, I just want to run my small business. I love what I'm doing. I don't need to do a budget. I just look at the money in the bank account each month and it seems to grow each time I look at it, so I don't need a budget. I'm too busy in my business. I'm just too busy on the tools to do it, or I don't have the skills to do it. And I tried to do one, but it was just too hard. Well, it's like me. If I wanted to fix a door in my house, I'm going to get a handyman in because I find it too hard. If you don't know how to do a budget in your business, talk to your bookkeeper, talk to your accountant, and say, "Can you help me prepare a budget?" And they'll probably do most of the work, go through it with you, and then you know what you're aiming for. I talk about a budget as being like um, playing darts. There's a bullseye on the dartboard. Now, if you've got your eyes open, you know what you're aiming for. That's what a budget is. But as soon as you put a blindfold on, i.e., you don't have a bit, you don't have a budget. Well, you don't even know what you're aiming for, really. So that's where a lot of the financial mistakes tend to happen. And the most often, the reality of not having a budget is people say, "I have to pay what in taxes?" You're joking, or unexpected payment comes up and they've got to say, "Oh, I just don't have the money right now," or particularly if the business is growing, my accountant's saying I'm making money, but it's just not showing up in my bank account. And the other one is I had money at first, and as the business has grown, money just flew out of control. That's really a common one for businesses that have grown from maybe, one tradesman and an apprentice to a team of 5 or 6. The business got a lot more complex. There's a lot more superannuation, work cover, rent, staff amenities, all these things start to accumulate, and you haven't kind of looked at your budget to address that. The third biggest mistake is not knowing what the break even is in your business. And break even's just exactly that. Break even is the point where total revenue equals total expenses. In other words, breaking even. So when you look at a profit and loss account, you've got income, cost of sales, and then you've got gross profit. And then underneath that, you've got overheads or fixed expenses, in other words, and that gives you a profit and loss at the bottom. So you total up the fixed overheads or fixed operating expenses and divide it by the gross profit margin. There's an example there. And that gives you what the break even is for the month. So in this particular example, the business, based on 40% gross profit margin, would need to make $48,445 to break even. So a couple of pro tips here. Go through the exercise. Work out what your break even was last month. Run your profit and loss for September. Have a look at your fixed operating expenses divided by your gross profit margin. That's a really powerful number to know because it means setting targets seems so much more realistic now. Next, work out your daily break even. This is the number it costs you to open your doors or business every day. So the simple way to do that, in most months, there's 21 business days. Most months, some have 22. So you get the 48,445, and you divide that by, say, 21 business days, Monday to Friday. So that gives a daily break even of $2,306. So if you know that, then you can set a target. You know that every day, at a minimum, your business needs to generate $2,306 of income that day. That all of a sudden plays into your hands because then making sense of the numbers becomes so much simpler because you know what your target is. Look, we just have, at a minimum, we have to do $2,306 per day. So you can start organising work to exceed those sorts of targets. And that's what I'm talking about there. This is a powerful number and allow you to set daily targets and track daily performance. So if you know that you've scheduled, what your break even is, to say it's $2,300, you've scheduled $3,200 worth of work for the team to do tomorrow, and then the next day they only do $2,300, you can ask questions about what happened yesterday. Oh, what happened yesterday? Oh, and then you can uncover some of the reasons as to why your business is losing money and not hitting the targets that were set. Like a bit of experience I've had with that is, that exact scenario, 2,300 break even. There might have been $3,200 worth of work scheduled. And when the business owner comes to work the next day, they have a look at what what work was done and work out, it's actually only $2,300 worth of work. What happened to the other $900? And ask questions of the team, and they work out that one of the team didn't have the right tools when they got to site, so they had to drive back to the factory, which was 45 minutes away, pick up the right tools and drive back to the work site. So, then you've got two people in a truck or a van, spending money on fuel and wasting time driving around, picking up tools that should have been there in the first place. The fourth biggest mistake is not reviewing financial reports regularly. So, if you're heading towards a destination, you've got your budget, you know what you're trying to achieve. I would say to you that you should be setting some non-negotiable rules in your business. And the first one being that you pay yourself a proper wage. What would it cost you to get someone else to do your job? Pay yourself that. Second, that your business should make a 10% plus net profit, right? You need your bookkeeping organized to prepare your budget. But once you've got your budget, then you've got your blueprint or your financial goal of what you're trying to achieve. We're not talking about changing things dramatically. Sometimes it's just a combination of little 1% and 2% changes to expenses and incomes and margins, those sort of things can actually deliver the results that you deserve in your business. And that's what this is about. This is what paying you what you deserve. So, you know, you're not going to review your reports if you don't have your bookkeeping organized. You're probably less, you're also not as likely to review your reports if you haven't got a budget in place. Because what are you reviewing your reports for if you don't have a budget? If you're driving from Melbourne to Sydney, you want to check in and, understand the progress that you're making towards your destination. And that's what reviewing your reports is all about. It's like, well, what do we set for the month? What do we try and achieve financially for the month or for the quarter or for the year? And how are we going on track with that? It's really, really important too, because if there is something not right in your financials, maybe your margin's wrong or your expenses are more than they need to be or revenue's down or something like whatever it may be, there's a whole heap of different reasons. You want to understand sooner, right? Not at the end of the year. I would want someone to tell me that as soon as possible, not wait 12 months, wasting my time, being busy, stressed out, family life, all that sort of stuff, just to work out 12 months later that, you're off track. So that's what reviewing your financial reports regularly is all about. You've got your budget set and you're reviewing your financials against, what you set out to achieve. So a couple of key points there, 1, 2, 3. As a business owner, you need to be looking at the financial reports at least every month. This will give you a clearer sense of how your business is operating. And again, having that tied back to your budget. And, for all those, the statistics say that 6 out of 10 small business owners don't feel they know enough about accounting and finance. So that probably means 6 out of 10 small business owners aren't reviewing their financial reports because they don't understand it. But if you go through the effort of the review process, you begin to see obvious errors and you can put a circle around. If something doesn't make sense, ask the question of your bookkeeper or your accountant or whoever's doing it. Say, look, I didn't quite understand how this expense, explain what this is for. Or I thought we had revenue higher than that. What happened there? So, that review process can take 15 minutes. It's not we're not talking an afternoon, and you might not know the answer, but you ask the person who does. And by doing that, you're actually building up you're investing in your own knowledge of being able to understand your numbers more clearly. So the last one is also by reviewing your financial reports regularly, you are holding yourself accountable and building the knowledge of the accounting and finance function in your business. I've got a great story that happened to me as an accountant yesterday. So on my bank statements yesterday, because I'm an accountant, I review my reports. I had 2 charges to this company called SignNow, which is like DocuSign. I thought that's not right. I've only got 1 user account. So anyway, I had to look through my records, and the same thing happened last year. And I got onto the Let's Chat bot, with the Sign Now operator, and we'd actually uncovered that they've overcharged me 3 subscription fees over the last 2 years of about the US dollars, that's about $400, and it was which converted to about $700 Australian. So a couple of hours talking on this chatbot and going through my records, I found an error of $2,100. So plus, that's the power of just looking at your reports and having your bookkeeping organised and being able to find it, being able to get your fingers on the information when you need it. And I think that every business has that. So many subscriptions now, and a lot of them are so sneaky. Like you sign up for 12 months and you've got to opt out, and you don't remember to do it until the new subscription happens. And their terms are that once the new subscription you can't cancel. You can't cancel for another 12 months. So these sort of things all sort of creep in. Okay, so I think I've got this one nailed today, Dom. So I'm going to just stop share for a minute, and I will reshare in a second. Hang on. So tax planning is the next biggest mistake that small business owners make. And it's basically your right to arrange your financial affairs to keep your business to a minimum. Depending on the size of the business, this could save you $10,000, $20,000, $30,000 a year. So it's definitely money well spent getting your tax plan done, particularly if it's going to save you that much in tax. So let's listen to what the late, great Kerry Packer had to say about it.
What the Four Corners program suggested was not that you were evading tax at all, that would have been libelous, but that you were minimising tax.
There's nothing wrong with minimising tax. I don't know anybody who doesn't minimise their tax.
And that you were doing so in ways that were contrary to the spirit of the law.
Oh. Well, I just got through telling you what I thought about that. And what you're saying is exactly what the Four Corners program says. I am not evading tax in any way, shape or form. Now, of course I am minimising my tax, and if anybody in this country doesn't minimise their tax, they want their heads read. Because as a government, I can tell you, you're not spending it that well that we should be donating extra.
Yeah, so I'm just going to pull that up again. So, the thing is that, with online accounting and Xero and these sorts of things these days, tax planning is not just for billionaires, it's actually for small business owners. Having your bookkeeping up to date, having a budget in place, reviewing your financial reports, we kind of know how your business is going month in, month out, quarter in, quarter out. So when it gets to the pointy end of the financial year, we can often forecast what your expected tax liability is looking like, and then provide you with some suggestions or recommendations of what you could potentially do to save tax. Look, the tax law changes all the time. So there's always bills going through Parliament adjusting taxes. And for example, the instant asset write-off is no longer. Now the instant asset write-off is up to a maximum $1,000. So that's 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 a massive change in tax planning. But it's not for billionaires. It is for small business owners. It's not an expensive exercise, and the return on investment is often huge. So, that's $30,000 that you could be, investing back into the business, retiring some debts, going on a family holiday, whatever it might be. The point is that, tax planning, if you people often say, my accountant's costing me money. Well, tax plan is one of those services where we're actually adding a huge amount of value because, it might be costing you, a few cents in the dollar for each dollar you get back in terms of tax planning. Potentially. Every business is different, however. So, what's right for Dennis's business is different to Ryan's business and all that sort of stuff. So, but, a good relationship with your accountant can, get those sort of things, scheduled for your business so you know where you're going. That's the other thing about tax planning is that, 6 out of 10 small business owners feel like they don't know enough about their accounting and finance. Tax planning is one of those things that you're going into the 30th of June knowing approximately what your tax debt might be looking like, approximately, and what you can do before the 30th of June to minimise that, and what effect that will have on your total tax bill. So, when you're talking to your accountant, when it comes to the tax time, when you're lodging your tax returns, there's no surprises. You've been informed before the event and after the event, and was in line with what you're expecting. The next, look, tax planning strategies. This is a little bit complicated. Could seem a little bit complicated. Just look at the yellow. So we've got two. This is the same business. This is just it's got heaps of errors in it, but it's just to demonstrate the point. There's hundreds of different tax planning options and strategies available, but this is just one, and it's very simplistic, just to demonstrate the point. So if we look at the yellow, the director has reduced their wage from 150 to 100. The tax payable in the company is still 0, but the total tax payable for the director is reduced from 40 down to 22, which led to a $17,500 saving. There's a few Division 7A issues in this, that potentially could flag themselves. So don't do this at home, kids. Get professional advice around it. That this is where your accountant really earns their stripes, I suppose. But I would be delighted if my accountant came to me and said, "Look, I think we should be reducing your wage, or increasing your wage, or paying a dividend this way, or reducing a dividend, or whatever it might be." Particularly if it's going to be saving me tax. So some general strategies there is, you always have a look at the business structure. Sometimes sole traders need to turn into a company, or sometimes trusts need to turn into a company. So we've got to understand the business structure. And you're looking at a forecast tax position in April, May, a couple of months before the end of financial year. So what your tax liability is, what you can do before the 30th of June, and then just sort of review which options best suit what you can do. So this is all driven by you guys, and sometimes I think it just helps to sort of see things in a little bit of context, because sometimes trades and construction business owners don't love accounting and finance. It's not your forte. That's why you're good with your hands and tools and that sort of stuff. But all these things come into play to really make your finance function a strength of your business, and it all depends on bookkeeping, setting a realistic and achievable budget where you're going to pay yourself a proper wage and make a 10% profit. Tax planning where you can save 17,000, whatever the dollars are for your particular circumstances before the 30th of June. And so when it comes to doing the tax and financials, there's no surprises. Now, often people see these things in isolation and can't understand the value, but the point of this sort of infographic is just to sort of draw your attention to, these are all the things that really make you empowered and understanding your numbers clearly, knowing, what your margins need to be, what your break even is, what daily revenue targets you have, how to pay yourself a wage, and the business should be making a 10% minimum or 10% plus net profit. So thank you, guys. What are the challenges that you're looking to overcome? So I've got a ProTrade offer there, 45-minute discovery consultation. So the aim of that is if you wanted to sort of ask me any questions, I'm happy to spend 45 minutes with you one-on-one. The idea of that is really to give you as much value as possible as I can in that 45 minutes. Admittedly, I don't know all the backgrounds to all your businesses and that sort of stuff, but I can, what my aim or passion is that I want trades and construction business owners to be paying themselves proper wages and making 10% plus net profit. So, I'm more than happy to kind of help guide you with any of that. So if you're keen, just use the QR code there and just book into my diary, and I'd be most welcome to sort of chat to you about that. And that really is it from me, Dom. But I'm happy to field any questions or have any comments if anyone's got any comments.
Yeah, absolutely. I was going to say, unshare that screen, and I'd love to throw to the group. I mean, there's a couple of things that I certainly jotted down. Doesn't matter how many times Lyndon and I catch up and have a conversation similar to this, but there's always a couple of things that seem to stand out. Did anyone have any specific questions for Lyndon while we've got him here off the back of what he was sharing? Anyone got some takeaways? I think the common thread here is, you know, for some of you, maybe you're really good at it, maybe you're passionate about it. But I think for a lot of us, it's not our bread and butter. So the thing there with Lyndon was just the reminder and the support around investing in the professional help. And it frees you up to add value to where you add value.
Yep, 100% there, Don. Couldn't agree with that anymore.
Yeah. I might just do a couple of quick takeaways, Lyndon, subject to how you're going for time. So who wants to kick things off? Who's got a bit of a takeaway? We'll whip around the group. Mary? And if you watch back your recording, Lyndon, I love your commitment to the presentation. So Mary and her husband, Charles, are, what is it now? Is it almost 5 in the morning where they are?
It is
Oh my
now
goodness.
5:30
Where are you?
in France.
Ah,
On our big,
stop it. That sounds good.
I know.
So
We're here for the Rugby World.
They're doing
Oh,
incredibly
beautiful.
well, energy-wise. But if you're wondering, if you review it, I think they're doing well. But what about for you, Mary? I know
Charlie.
you're writing a few things down. What came up for you?
Yeah. I'm a big note taker. I had to cringe when you said don't do your own bookkeeping because I do the bookkeeping for us. But at least it's me and not Charlie trying to do it, which is one thing. But then also budgeting. There's just something in what you said, because I understand about doing budgets and all of that, but they are always just too hard and just blah, 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 blah. But there was just something about what you were saying in and around the budgeting, about it being that target that you're aiming for, and then you're reviewing your financials against them. I know this sounds stupid at my age to have only just realised how this all works.
No.
But then reviewing that against the actuals and saying, oh, well, we're overspending here but underperforming here, or vice versa. So that you've got something to compare it to. You're not just looking at it compared to last month, compared to next month, but you're actually saying this is where we want it to be. Yeah. So
it's like driving to a destination and you don't know which destination you're going to. Like you're checking the GPS map and it's saying you're in Brisbane or Canberra or Perth or Sydney or wherever. And what's that in relation to? Were you driving in that direction?
Exactly. Yeah.
And that's what, and look, that's part of the budget process, is really to sort of say, you know, what are the fixed overheads of the business? You know, we've got staff salaries, we've got rents, we've got super, we've got work cover, we've got printing, stationery, motor vehicle expenses, all those things. We know kind of what they are. You as a business owner would have a good sense of what you think you're going to achieve sales-wise for the year. We know what your gross profit is based on historical information. So we can sort of play around with those levers to sort of say, well, what is the goal here? You know, for many small trades businesses, it is to pay themselves a proper wage and to make a 10% plus profit. Maybe it's to make a 20% profit if you're already paying yourself a wage. So what needs to happen with that budget to achieve the goal that you want to achieve? So is it to increase revenue, or is it to increase the gross profit margin 1%? Or is it to trim expenses? Or, you know, we just got to look at what's realistic. And I think that's done in consultation with you, Mary. So it's not someone just saying this is what it should be. It's got to be done in consultation, because as an accountant, I don't know the ins and outs of your business. And you would have to sort of add your filter to it to determine, yeah, look, I think we could increase prices, or we should, maybe it's reducing prices to increase volume. So it's lots of different sort of scenarios come to play there. And then you can sort of say, well, look, I know that this is what I want to achieve and I can do it, because that's the game plan. This is the blueprint for me achieving my financial goals. So when it comes to quoting or discounting, or, you know, what work to aim for, or what work to walk away from, you've got that confidence, you know. So if someone says, oh, look, you know, Mary, you gave us a quote for 10,000, but your competitor gave us a quote for 9,000. If you match their price, I'll give it to you. You know, if that doesn't fit in your model in terms of what you're trying to achieve, you would have complete confidence to say, you know what, no, we're not going to do it. I know the value that we provide, and that's the price. And if you want to try your luck with, you know, cheapskates down the road, I hope it works well for you, but that's our price.
Yeah, but
And
saying that, yeah,
the confidence.
with knowledge behind it, yeah, and confidence, yeah.
Thank you, Mary. Matt.
Yeah, thanks, Lyndon. That was great. Just a couple of questions around it. With the we're formulating a budget now, operating budget, income expenditure. We've never had one before. At the moment, I've sort of done this financial year based on our figures from last year, and
That's a good starting point. Yep.
yeah, adjusting seasonally for some of the months where we know we're going to have 3 weeks holiday, etc., and some weeks with some months where we know that income is going to be slightly higher. We're doing what we are doing is using a fairly standard sort of what's the budget function in Xero. We've used a normal Excel one previously when I set one up years ago, but we're now using the Xero one. I'm just wondering, what we're doing is at the end of the month, obviously going through and then adjusting it for actuals. Should we be running two, have an actuals one and a predicted one, or are we sort of missing some information if we're overwriting what we're predicting with our actuals, or is that the way to do it?
No, so I see it as sort of two columns. So in September, you've got your budget, and then you've got September your actuals. So you're actually looking at. I actually like the process of writing in the results against the budget. So
right.
So I do a big sort of chart, and I have a what the budget is and the actual next to it. So you can actually. I like to get it up on the wall too, so it's not living in a computer that you have to dig up, but it's something that is in your office that gives some ownership to it.
Yep.
So yeah, and the thing about the budget is it's a forecast. It's and you're going to have ups and downs along the way, and you just want to of course that's it's not going to be steady, but it's just a matter of just making sure that over the course of the months or the quarters is that you're on track with what you budgeted was achievable. So the key things there are what you said then is, sales. You always sort of base the budget on what happened last year, but sales adjusted for seasonality.
Mm-hmm.
Your gross profit margin, or cost of sales. That's usually a fixed percentage.
Yeah.
And then your overheads, and really you want to be as part of those overheads having a wage there for yourself, a proper wage, because if it's great to make a 30% net profit, but if that 30% net profit was because you didn't pay yourself a wage, then you're kidding yourself, right? Because if you put a wage into the business made 0% profit.
Yep. Yep.
So that's why I'm saying, like, you've got to have a budget, you've got to have a wage there for yourself, because if you leave the company stops. So you should be paying yourself. And then after that, the business has to make a profit of 10% plus.
Yeah. Okay. And to work out one of the things that's really hit me today has been our cut-off points, where we're making $1 in some of our accounts and where we're not with some of our clients. So I really want to get that under control and understand what's going on there. The gross profit margin, am I plucking that out of like last year's figures and going, well, we know it at end of financial year. We've only just done our first financial year for this new entity. At the end of the 22-23 financial year, our gross profit margin was 40. Are we, or whatever it was, I think it was 36. Are we applying that this year as our magic number, or is there another way for me formulating that?
And that's exactly what I call it, the magic number. Gross profit margin is your magic number. That's the number you need to know. And it's great that you know it. So you definitely, you're one of the 2 out of 10 that probably has a good grasp of your finances and accounting. But when it comes to your gross profit, and you might have restructured for whatever reason, and that's all fine. But a couple of sources you go to the financial statements for the accountant prepared last year or most recent. That's going to have the most, last year and the year before then, so you can calculate, or the gross profit may be displayed there.
Yeah.
So you can see what it was 2 years ago and 1 year ago, and where it is today. So other sources would be your bookkeeping file. Now, this is actually why bookkeeping is so important, because if you haven't got your bookkeeping organised, running your gross profit figure may not be right. I've seen people put telephone expenses in gross profit. I've seen them put rent and motor vehicle expenses in gross profit. they don't, 99% of the time, they don't belong in cost of sales. So, that's where the bookkeeping sort of comes to play, because you want to, that magic number, you really need to own it, whether it's 36% or 40%. And I hope it's going from 36 to 40, Matthew, because you want that gross profit to be growing.
Yep.
And that good gross profit is actually a sign of business efficiency and also customer satisfaction, from my point of view. If your gross profit's going down, there's some causes for concern there, whether it's customer service or workmanship or delivery or scheduling or production or whatever it might be. But a high gross profit or an increasing gross profit margin is a very healthy sign for any business.
Yeah. Okay. All right. Thank you. That answers that one.
Beautiful, Matt. And reiterate, we do a financial forecasting session, Lyndon, after session 2. And so these guys will get a bit of extra context off the back of what you're chatting about. So, Matt, I know that will help part of your question as well. We'll do some budgeting, some forecasting. Beautiful.
Yep.
Any other questions, guys? I know I was going to do a checkout, but I might just leave it to if there's any other questions before we let Lyndon go, and really extend that invite if anyone wants to take Lyndon up on that offer of connecting
Lyndon.
for 45 minutes. Tom, over to you.
What would you say for? I'm just looking at one of my P&Ls here, just for this year. I've just got my cost of goods sold in my before gross profit, and then my wages and salaries are all in the operating expenses, including my overheads, as well as like I have an apprentice, so the apprentice's wages in there. However, we saw Dom put up one earlier, and it had the wages in the before gross profit. So where should that be? Like where should my on the tools? Yeah.
Yeah, ProTrade recommend that you put your employment expenses in cost of sales, and the reason for that is they want to know, what the gross profit is after labour. So, what you're talking about there, Tom, is, probably 9 out of 10 businesses have their wages outside of it, but within ProTrade, their methodology is somewhat different, because what they're trying to get to is how much are you making off your labour, which I agree with. So, that's fairly easy to change in your software. It's just a matter of reclassifying it. Instead of classifying it as an overhead expense, reclassifying wages as a cost of sales in the cost of sales section, and then you can get that.
Yeah.
So yeah.
So there's no right or wrong. It's just okay. I just didn't realize.
Yeah. There's no.
Because all my subcontractor labor is in the cost of goods sold. My subcontractors are used. However, the direct employees are in the operating expenses.
Yeah. And that's don't stress about that. Like, that's common. I think ProTrade has got a different sort of sense of what, to simplify things in terms of recognizing that, you need to be making a profit after labor. And I think that's one of the reasons they put it there. Dom can probably go
makes sense.
Yeah, and it's a great question, Tom. And I'll often share this morning. There's definitely no right or wrong. The big piece is back to Lyndon spoke about the magic number. Gross profit is what pays for the rest of your business. So consistency is the key. Tom hit the nail on the head. At least the contractors are not part of the overhead. The only other thing to bear in mind is that won't skew your break even. Your break even will still be your break even. So if those wages are part of the cost of goods sold, it will just impact your gross profit percentage versus where they are, which will then increase your overheads. So I might be confusing the situation, but just understand, regardless of where you report on that, it's not going to affect the break even number.
Yeah, that's right.
Thanks, Tom.
Great question, Tom.
Cool.
Good on you. All right, guys. Well, look, fantastic to see you all. Thanks for the invitation today, Dom. I wish
thank you.
With your ProTrade journey. You're in good hands, guys, and I'll speak to you all soon.
Thanks, Lyndon.
Bye.
Have a good afternoon.